Yeah, we like to look on inventories. We really key off of total petroleum inventories. So you can have, at any given moment, you can have a middle distillate or diesel shortage. You have a gasoline glut in oil. You have to net out the SPR stuff, but we look at the whole picture and we compare the current draw or build for each week to the 5-year average. And we like to take that if you're drawing more than you expect for that time of the year, then that's bullish. If you're building more than you expect, then that's bearish, right? So that's basically how we look at inventories on a total petroleum basis.
And where are you getting the data? I mean, there's a couple organizations that report inventories, and there's revisions. What after all these years doing it, where do you get your data?
The best data is the EIA. So weekly US data is the best. And so everyone wants to know what's happening globally. In China is always the black box of the oil market, and we can all speculate, but no one knows. And so what I did a long time ago is it goes back to what works, right? We tested the weekly EIA data that comes out every Wednesday at 10:30 and tested that as an indicator. It holds up really well across multiple regimes. And I'm telling you, oil is a tough market. You find something that works for 5 years, and the next 5 years, I bet you anything it doesn't work. So if you can find something that has a steady, decent track record, you want to grab it and put it in your back pocket. And so that's what we've found with weekly inventory data out of the US. The big pushback you get is that, hey, this is a global market. What are you missing? Only looking at US data in your model. And what I say to that is that this is a globally interconnected market still. And so if you we would see it, we have spreads going on in our physical side of our model too. So let's just say there was a glut in the Atlantic basin or in China or some other part of the world, and it started pushing down Brent crude oil is still like 70% of the world's crude is benchmarked to Brent. So you would start seeing Brent soften relative to Louisiana light sweet crude, which is a US benchmark on the coast, and that would back up versus WTI. And you would see those spreads start to worsen, and that would be a leading indicator to potential inventory troubles in the US. But the bottom line is the US inventories don't get out of whack from global fundamentals for more than like 4 weeks. That's the most you can see it get out of whack. And after 4 weeks, it'll come back in line. So that's the pushback. My testing says it's totally good enough. And what you lose in your global view, you gain in the fidelity of the data and getting it every week, every Wednesday at 10:30.